It's surprising to consider that Disney stock is still down over 49% off its high. Now, the company is not perfect. There are plenty of risks, which I will highlight in this video. But I feel at current valuations, Disney stock makes an excellent long-term investment. I'm going to share with you all the reasons why I think that's the case. And I'm also going to touch on the risks, like I mentioned. So let's get started.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Disney stock still down 49% off the high. And the reason I find this most surprising is because during the pandemic in 2020, when most of its theme parks, its hotels, its resorts were closed for business, the company's stock price was reaching all-time highs. And then in 2023 and 2024, when its theme parks were reopened and absolutely booming, generating the most profit they've ever generated in their history, the stock price was falling. So I was surprised at that difference there. And, the primary reason for that was investors were valuing Disney's streaming business more so than they were valuing the theme park business. And when the economy was in lockdown, Disney's streaming business was growing at much faster rates than when economies reopened. And so that's what created that big difference in valuation for Disney's stock price. But let's take a look at the company's revenue over the last decade. So you'll notice Disney's growth has been exceptional in the last decade, revenue nearly doubling from 45 billion up to 89 billion. Of course, this was partly helped by acquisitions that added revenue to Disney's total. But even without that, organically, Disney's business does grow, not very quickly. It's not like one of those, it's not like Nvidia. It's not going to grow revenue at several 100%. But it would be reasonable to assume Disney's business to grow revenue in the mid to, I would say high to low double digits, 8, 9, 10, 11% revenue growth would be reasonable to assume for Disney through a combination of factors. Of course, price increases. Disney has been well known to be able to execute pricing power. You'll notice if you've gone to Disney's theme park in the last year, it's much more expensive than it was in 2019, which was still much more expensive than it was in 2010, which was still much more expensive than it was in 2000, as Disney has continuously exercised its pricing power, incrementally adding cost across the spectrum for its theme parks, right? Increasing prices on parking, which are now $35, I believe, at Disneyland. 2019, they were $18. So they've doubled the price of parking. Price of admission, of course, the most obvious price increase. The price of food. Incremental services like Genie Plus, which allows you to skip lines, but you've got to pay $25 or $30 or $35 per day per person extra on top of your theme park ticket. And then hotels and merchandise, etc., right? So they've been able to exercise that price increase, which I feel they'll continue to be able to exercise over the next few decades as well. And then they're adding new segments, new business. They recently opened that theme park in China. It's been a little over 5 years now, and there's reason to assume it'll be able to open newer theme parks. It'll be able to add newer resorts, newer hotels, and they're introducing newer cruise ships to their fleet. So combination of factors will drive revenue growth for Disney's theme park business and in-person business. The content side of the business is the more interesting one to consider right now. It's undergoing a major shift, right, from the linear consumption where people watched television through a cable or satellite connection to the streaming connection. And that change is causing major disruption for Disney because it had established a very lucrative revenue source in that model. right? People were subscribing to that cable bundle, and Disney was reaping the benefits of that bundled service. Now that streaming services are more, individualized, Disney's business model in that segment will have to find a way to generate the profit margins it was generating in the linear segment. Okay. So that's going to be disruptive, and that has been disruptive. And it's led to billions of dollars in losses in Disney's streaming segment. Disney management said, though, that starting by the end of this year, the streaming segment will be profitable. And the streaming segment is one of the areas I'm most bullish about, because if you look across the board, the streaming industry, nearly every streaming company is raising prices and at the same time cutting content spending. So that leads to better profitability for all the streaming companies, and customers leaving a choice where they say, well, everybody's raising prices, everybody's cutting content spending, everybody's cracking down on password sharing, and so we don't have anywhere else to go. We might as well stick around with the streaming services that we have. So that industry-wide trend is working in Disney's favor. And also, the switch from linear or cable or satellite connection to streaming connection is going to increase content consumption industry-wide. People are going to watch more content. People have been watching more content and engaging with the streaming platforms more often because it's more convenient. You can watch it on your phone while you're in an Uber ride heading to school, or while you're on the train going to work, or while you're on campus between classes when you have an hour break. You open up your laptop and you watch something on Disney Plus or Hulu or Netflix. And so consumption is increasing, demand has increased, and that could offset some of the impacts of the profitability difference between the linear connection and the streaming connection, although maybe not completely. And then finally, Disney has yet to fully embrace streaming with the sports side of the business, ESPN. And that's coming, it's working on it, and once that comes out, the streaming segment for Disney will really generate great profitability for the company, but that will hurt the legacy side of the business even more. So those are the catalysts for Disney in the near to mid-term. And already you're starting to see the increase in profitability, right? When the pandemic was devastating for the company, operating profitability collapsed, but now it's back up to 11.81%, but it's still at roughly half of where it was pre-pandemic. So there's still room to go to return to that level of profitability, which it's reasonable to assume that it will return to that level of profitability. You've got the cash flow from operations to sales rebounding again up to 15%, but again, not up to the levels it was at before the pandemic. Now, looking ahead, Disney's expected by Wall Street to increase their earnings per share by 18% each year over the next 5 years. That's robust earnings per share growth, to be sure, especially when you consider the stock is trading at a forward price to earnings of 18. Now, there are some risks to Disney, and one of which is the change in consumer behavior from the streaming to the streaming connection, from the cable segment connection. The other is how they turned off some customers by their political views and politicizing their videos and the messages they were trying to incorporate into their movies and shows. That turned off a lot of customers. So will they be able to recapture those customers longer term? Maybe, maybe not. So that's a risk. Recent movies have not done that well, although the one that's out most recently, Inside Out, is doing really, really well. Already $438 million in worldwide net revenue in less than 2 weekends out. So the latest movie doing much better, but the latest group of movies, the latest batch of theatrical releases have not done all that well. They haven't had that big billion-dollar hit in some time now. So there are some risks with Disney, but longer term, I feel at current valuations, it makes an excellent investment for investors willing to hold this stock for several years. This isn't going to double overnight. This isn't one of those types of investments. This is one of those buy and hold for the long term type of investments. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.